why has this innovation been taking place outside of the banking regulatory perimeter? I think a part of that is sort of the attitude of regulators towards innovation itself, right? Which, to be fair, has oscillated between administrations, right? I
Mhm.
mean, if you look back at Yelena McWilliams at FDIC or Brian Brooks at OCC, certainly had a much more accepting posture when it came to sort of new ideas or new approaches. I think we have definitely seen that pendulum swing the other
Mhm.
direction under current leadership. And not to say that that's not warranted, right? We've seen stuff blow up.
Welcome to the Operate Podcast, where we give you a behind the scenes look at company building from the perspective of the builders themselves. This is how we operate.
Welcome to the Operate Podcast. I'm Kerry Ransom. Today's episode is sponsored by BankTech Ventures, the first strategic investment fund designed by the community banking industry for community bank innovation and investment. BankTech identifies leading products and technologies for community banks and works with the founders and management teams to maximize the impact for the community banks and their businesses as well. If you're a bank looking to innovate and invest in the future, or a founder who wants to work with community banks, reach out to BankTech Ventures at banktechventures.com. My guest today is Jason Mikula, and he has a long history, which we will get into a bit today, in financial services and fintech. And he's currently covering it as what I would call an analyst and a writer for his publication, Fintech Business Weekly. He also is doing a lot of advisory and strategy and consulting to a number of financial service firms and startups. And I think a lot of that comes from that experience that we talked about. He was early in fintech before it was really cool. And we'll talk about that and how people develop expertise, which he probably will agree with me is typically lived and learned experience, which I think we both have a lot of those scars to show from those adventures. And the other thing that I really am excited to talk to Jason about, we haven't talked about it previously. We both actually have a fair bit of experience in history and digital marketing. And I think it's actually one of the core foundations of digital financial services and something that a lot of existing banks don't understand. And I want to talk to him about that as well. Jason, thank you so much for joining me on the podcast today.
It's great to be here. I wish I were in presumably sunny Southern California. I went for a run today here in Utrecht, which is just outside of Amsterdam, and it's 55 degrees and raining.
Ooh, yes, we I will definitely win the weather award over you today. But I guess that's part of why I live here is most days. I do get that. Well, let's start good jumping off there. Let's start with sort of personal background. So, yeah, I know you grew up in Chicago area. What was it that got you interested in financial services?
Yeah, so I like to joke that I feel like I was one of the least likely people to end up in financial services. I studied political science, did my master's degree in sociology, I went off to serve in the Peace Corps, had a very challenging assignment in the British West Indies, living in the Caribbean island nation of St. Lucia for several years. And really, and like, keep in mind to date myself, this is like 2010. So really the very early days of digital marketing,
Mhm.
Google Ads and Facebook and stuff like that. There was no you didn't learn that in school and
For
university. You
sure.
learned it because you were like interested and taught yourself. And when I came back from the Peace Corps, I freelanced for a while and then realized like, oh man, I need health insurance. And I was recruited by a company that's still around, publicly traded, called Enova.
Mm.
Folks who are listening like may or may not be totally aware of that company, but it was a very early innovator in doing lending online, which now we all take for granted. But I want to say they started doing online loans in like 2003 or 2004. And actually, the gentleman who founded that company went on to found Avant, which people may be more familiar with.
Mhm.
So yeah, I mean, my entry point was I was recruited to join this company in a digital marketing role, so managing customer acquisition marketing for their US subprime product, which I didn't even know what subprime meant,
Mm.
and that's how I got my start.
Very cool. Well, I talked to you a little bit about this, but I'd love to go a little bit deeper there in that doing that online, right? You probably had some kind of target cost per visitor, cost per applicant, cost per funded loan. I mean, what were some as you were first getting into this? And that's obviously been an evolving market in digital financial services. But as you think back to that start, how were you trying to benchmark the target either success or the funnel as we really think more about it probably today than you did then, and your improvement or indicators of success?
I can tell you're a marketing guy because you have it exactly right. And I mean, the metrics were CPF, cost per funded loan,
Hmm.
versus they used a different term, but basically versus the lifetime value.
Yep.
And given the specific product, which is a state licensed product, the profitability actually varied substantially state to state,
Mm.
right? So unlike, something like a whatever, like a lending club or a SoFi, or lenders that partner with a bank and have the same product nationally, it's actually like you had, I think it's like whatever, 25 or 28 distinct products based on what was permitted in each state the company operated in. And thus you needed to tailor your marketing effort and sort of what those metrics looked like to what was happening in each specific state. And then, sort of more broadly, you talk about a funnel, right? So it's like, okay, and I'm thinking like these are Google Ads days.
Yep.
Thankfully, I did not have to run direct mail at that job.
Okay.
I have some exposure, but it's not my favorite. Looking at that journey from impression, click, somebody hitting a landing page, going through that application flow, approval rate, of course, critical in a credit product, and then funded. And then I've spent most of my operating career on what I would call the origination side, right? Getting
Hmm.
people in and funded. But of course, at a business level, it also matters if they pay you back.
That's right, especially with
And
loans. Yeah.
yes. So, certainly, interfaced with people in data science, fraud risk, credit risk to understand, hey, okay, so we got, whatever, how many thousands of new customers or new loans, but how has that portfolio performed over time? And then sort of recalibrating, looking at things like, you know, paid search versus social media, or even within paid search, people Googling, online loan versus cash advance. Are there differences in how these customers are performing that need to flow through into how you're optimizing your marketing campaign?
Yeah. So, I mean, we could spend the entire time just talking about that because those are topics I just love. And I think probably, if I'm guessing, as you started to realize, oh, an actual search term is a risk split of some kind, either better risk, worse risk, better indicator of how they're going to do. I mean, the thing that I felt like was such a gift when I got into fintech, I started in lending, was just having to learn and realize all these things that, as we used to say, it's really easy to give money away, but the trick is giving it to the people who are going to pay you back. And so closing that loop is so important, because you could have a reasonably good fixed cost on, or seemingly fixed cost on a cost per funded loan, but if they're all defaulting, you're actually upside down.
Well, and I do think that digital marketing skill set really lends itself well to financial services. I mean, even, and I've recruited employees, to work on teams for me who came from out of category.
Mm.
And certainly there's a learning curve around, the compliance stuff, which was true for me. I'm sure we'll talk about that as well. But as far as the analytical framework of, okay, I'm spending however many hundreds of thousands, millions of dollars, and I have certain KPIs I'm trying to optimize for. I mean, in digital marketing, maybe you'd more generically talk about like a CPL, cost per lead, cost per acquisition, same idea. I mean, I think in financial services, it it sort of takes that to the next level as far as sort of the metrics you need to be aware of and optimizing for, right? The in addition to the joke of easy to give money away, hard to get it back, um, the sort of ancillary to that is it's the only product. I guess this is true for insurance as well, but it's one of the only products where you actually care who your customer is.
That's right.
If you're selling shoes, it's like whatever. If you have money to buy the shoes, you can have the shoes. Whereas risk-based things, credit, insurance, it's like you actually care a lot about who your customer is because that determines, your profitability.
That's right. Well, the fascinating thing, at least for me also, was marketing and risk were at times almost, somewhat running counter or at least balancing each other. But once you understood, to your point, Jason, you understood who your ideal customers were, you could tailor your marketing to try to get mostly those to show up at your door. Once they're there, we have a lot of rules like fair lending and other things, which you obviously want to adhere to if you're going to be a legitimate business, and you have to treat everybody equally, which totally makes sense. But if you can, I think in a digital marketing world, you can do a lot on that front end to really try to make yourself as appealing as possible to the people you want. To your point, you care who these customers are.
And I mean, you would notice some interesting things that intuitively make sense, even if they weren't obvious in the data. So I'm thinking, during my time at LendUp, for a period of it, we partnered with Credit Karma. I'm sure
Mhm.
everyone knows what Credit Karma
Yes.
is. And even for applicants that had similar risk scores based on the credit model, if they came from Credit Karma versus they came from some other marketing channel, you would notice a difference in how they performed. And if you try to think through, like, why would that be? It's like, okay, somebody who's actively engaged enough that they're monitoring their credit score,
Sure.
monitoring their credit history, it it feels logical enough that that person might perform better, even if it's not picked up by the model, than somebody who's Googling like emergency loan.
That's right.
And so you do notice some of these interesting trends that you can use to sort of refine your marketing program.
Totally. Yeah, well, let's keep going because I know we could
Yeah.
talk about this all day. And I think the last thing I'll just say to put a pin in this is a topic that is not getting nearly enough attention specifically in financial services. That I think still you see a lot of financial institutions focusing on brand as this key differentiator, where so much of the tactical understanding the data, and that's where I've seen some of the best data scientists, some of the best even engineers I've ever worked with in my career, were that decade that I was in marketing tech and ad tech, because when you did it well, you had immediate ROI.
Well, it's one more comment. I promise we can move on.
Sure.
But I mean, it's a really challenging problem even for large, mature companies. I mean, think about PayPal, which I think maybe a year, 18 months ago, had to restate some earnings or some numbers related to its number of customers because it had a referral bonus program that attracted a bunch of fraud.
Hmm.
And again, if you're looking sort of at top line metrics of how many users did I get, you might look at something and say, I'm crushing it. Like, look at all these new customers. But you actually have to follow it all the way through to be like, ooh,
Sure.
actually, we have like a negative select bias because of this referral thing, and we opened ourselves up to fraud. So, like, actually, maybe we're getting what we think are customers, but it's actually not the customers we want.
That's right. That's right. And I think there's so much more to talk about and learn there. We may need to do a separate episode purely about best practices in digital marketing for the next wave of financial services. But great way to jump in. I mentioned you started Fintech Business Weekly. It's been almost 4 years. I'm sure it's flown by, and a lot of that are quote unquote COVID years. But let's go back to inception. What led you to actually start this?
Yeah, so as I mentioned, I live here in the Netherlands. I moved here for personal reasons. And after taking some time off from my prior role in London, it's like, I should probably get a job. And then, I did sort of the coffee chat, informational interview kind of circuit and realized, oh no, Dutch people don't borrow money, apparently. For a number of reasons, both sort of like culturally, historically, this is tends to be true in Germany and other nearby countries as well. There's also like regulatory component. I believe the cost of credit is capped quite low, which makes it difficult to actually do profitably. And I'm like, I spent so long painfully learning the ins and outs, particularly of the regulatory compliance piece. Like I said, I had no background in financial services.
Hmm.
So a lot of time sitting with lawyers and compliance people to understand all the acronyms, TILA, ECOA, FICRA,
Hmm.
GLBA. And that represents a valuable store of knowledge that I was like, well, if I work here, it's like worthless. So sort of the first point was I should probably, focus on consulting or project work or something, remotely, even though I'm based here in Europe. This happened to be basically late 2019, early 2020. So COVID or shortly COVID. And so folks were really, much more open to remote work. But then the problem was I can't leave my house. How am I gonna how am I gonna find business? And so, initially I kind of leaned into I can be a bit, I guess, long-winded. And so it's like, okay, Substack was just kind of blowing up as a thing. I'm
Hmm.
like, well, I should just do this, putting the digital marketing hat on as well. If I control the email addresses, I control distribution instead of relying on LinkedIn's algorithm or Twitter's algorithm or whatever. And so I sort of moved from, you know, writing short things on LinkedIn to this sort of more formal newsletter format. And that has really, evolved over time, both sort of like from a style perspective, as well as, hopefully the quality has gotten better after 4 years.
Sure. Well, it's always fun to look back at those early versions when I think when you decide to do any sort of form of content that in today's world has an evergreen nature to it, it's I think a positive to go back and say, okay, wow, I've gotten way better at this or something. So yeah, how what's your reaction been when you go back to some of those early, maybe even short form posts that you put on social media and where you are today?
Yeah, some of them hold up pretty well. I
That's
mean,
great.
I one of the sort of impetuses to do it is I was kind of like frustrated as a consumer of information with what was available,
Mm,
particularly in call it like the startup or the fintech space, right? So, I mean, you have, of course, your mainstream business publications, Bloomberg and the Journal and
mhm.
FT, which are great. And my dad compulsively emails me Wall Street Journal articles every morning. Bless him. At least he's not like physically cutting them out and mailing them
Sure.
anymore. But they only cover the biggest, the public companies and maybe the biggest fintechs. They'll cover
Mhm.
Affirm, they'll cover Chime now, Stripe, but they're not going to cover a Series A company because it's not big enough to be relevant to a general business audience. And then, the sort of startup specific sites, particularly in that sort of 2020 zero interest rate, everyone's raising a billion, jillion dollar
Yeah,
rounds.
yeah.
It felt to me very cheerleadery and not very analytical. So it's like I'm seeing all this coverage about how, oh my God, this new thing, BNPL. And I'm like scratching my head and I'm like, one, like credit distributed through point of sale is really not new. I
Especially
mean,
not in Europe. Yes.
yeah, yeah. Or I mean, Sears,
Yes.
was kind of like a pioneer in that space.
Sure.
Um, and then two, just sort of like a lack of critical thinking about things like the business model, right? I mean,
Hmm.
you know, Klarna being valued at $47 billion, and then you're trying to like look at it as a lending business, well, I guess lending slash payments business to be fair. And it's just like, how does the math on this work,
Sure.
particularly when, if you sort of read the writing on the wall, assuming there's going to be a compression in what their take rate was for offering this, which there has been. And so I was like, okay, you know, not that I want to be sort of like a naysayer, but more just apply like a methodical analytical lens
Sure.
and sort of setting aside some of the VC bluster or the cheerleading to ask like, okay, what is this business really about? Does it make sense? Is it being valued correctly? And so that's really, what I set out to do. I do think talking about looking back, one of the first pieces I wrote that really kind of, I won't say went viral, but at least got some traction was on BNPL and sort
Mm,
of at that point, like explaining the distinction between the pay in four style that everyone is very familiar with now versus an actual like installment loan distributed at point of sale that was like an interest bearing product
sure.
because there's a lot of confusion about that early on.
Well, I mean, the other reality, right? I mean, you had been in a company that had pretty strong data financial economics to it with your first job at Enova. And I'm sure in one you just defied probably the mathematical brain that you probably end up having to have to do that well from a marketing metrics standpoint. And you also probably had stock options in a bunch of these companies. And on one hand, we're probably going, wow, if they were really worth this, unbelievable. What? But on the other hand, going, this just can't hold up through time, right? So the challenge of that era, I just found to be so fascinating because people sort of go, well, I don't care if somebody else will pay. It's the sort of the whole greater fool theory thing of if somebody else is a greater fool, sorry for them. But how did you go? I just can't hold back anymore. I've got to at least put out my thought of what seems rational, but maybe I seem crazy to everybody else.
I mean, it seemed crazy to me because it's certainly not the first time of, some sort of, tech
Sure.
kind of bubble, but not only that, not the first time in fintech, even in recent memory, right? So you're talking about
Hmm.
stock options. I remember, when I was much younger and more naive and negotiating an offer for a startup lending company in San Francisco. And I asked, the founder, how should I think about how to value these options? I had never really had stock options
Hmm.
before. And he says, this is shortly after I think Lending Club had IPO'd around like $8 billion.
Hmm.
And he's like, well, if this is sort of the trajectory and this happens, like some voodoo math and like this is, it could be millions of dollars. And of course, what happened to Lending Club and also around that same time, On Deck Capital,
Hmm.
small business, non-bank small business lender, both of them IPO'd at these, lofty valuations. And then once they had the rigor of the public markets evaluating their financials, it was like, oh, well, this isn't really a tech business. It's a lending business. We're going to value it with multiples like a lending business and quickly lost like 90+% of their market cap. And that was like 2016. It wasn't even that long ago.
That's right. We in the startup world like to have really short memories though, and we can change the language to new terms, and that it's different this time. Let's come on,
Yeah.
Jason. We've
Yes.
been through this,
Yeah.
right? Well, recently you've gone pretty focused in on what I would call banking as a service and this whole, whether it was the middleware companies that were providing services between fintechs and banks and allowed this somewhat of an explosion. Curious, what led you to really sort of dig in that particular space specifically?
Yeah, I mean, this, I guess, maybe is a little embarrassing to admit, but the majority of my operating career was not in banks,
Hmm.
right? So I worked for three non-bank lenders,
Hmm.
and as we've discussed, in marketing roles and to a lesser extent, product management roles. And of course, I was also at Goldman building and launching the Marcus product, which is
Hmm.
also an interesting story. But I mean, there I was also like a marketing and product management guy. So to be honest, didn't spend much time at all thinking about the both sort of like the regulatory mechanics of if you're a non-bank fintech and you want to, you know, do regulated stuff, how does that work
Hmm.
from a regulatory perspective, from a economics balance sheet perspective? And yeah, and thinking about sort of like the balance sheet component of it and the economics there on the bank side, just because it wasn't, to be blunt, like it wasn't my job. It wasn't
Sure.
something I thought about. And as I sort of moved into, whatever it is I do now, you know, talking to people both on the startup side and then increasingly on the bank side, it's like, oh, in the United States, which is always an interesting outlier, if you want to do really anything, if you want to issue a payment credential like Visa, MasterCard, badge
Hmm.
payment credential, debit or credit, if you want to easily do nationwide lending and not state licensed lending, if you want to facilitate holding customer deposits, you have to have a bank partner,
Hmm.
period. And so, for all intents and purposes, any, and this gets a bit squishy because fintech, is a very broad term and includes
Yes.
infrastructure companies like Plaid and all sorts of other things. But if you want to have a fintech that touches any regulated component, holding deposits, moving money, issuing payment cards, you have to have a bank partner.
Hmm.
And so pretty much, all of consumer facing fintech is dependent on BaaS or dependent on partner banks. And so, me being the nerd that I am, I'm like, I really want to understand everything about how this works. And, here we are now in mid 2024 with, depending on who you ask, kind of well, one case of an extreme meltdown, which we can talk about, Synapse Evolve situation, and then sort of more broadly, sort of regulatory reckoning for all of the partner banks in this space, as far as consent orders and whatnot, and open questions about whether or not the economic model of these middleware platforms is actually viable, right? I mean, again,
Sure.
Synapse is, I think, an extreme outlier with the bankruptcy and everything that's happened there, but Rise exited to, I believe, Fifth Third.
Hmm.
It was acquired by, and then Bond was acquired by FIS, rebranded as Tilio. So I do think there's open questions about, as a business,
That's right.
is that a viable standalone business, or is it something that is part of a bank or part of a sort of a bank technology provider like FIS, Fiserv, or what have you?
Sure. Yeah, great questions, and thanks for sort of laying out that foundation. I mean, I'll just say, having been in the fintech partnering with banks world, I worked through two of those arrangements in my last two companies that were fintech companies partnering with banks. I didn't feel like there was a huge market for being in between that. It was great to have a business and to work with a bank for sure. But when I started to see the rise of these middle layers, I immediately said, that just seems like a small market. And I started seeing some of these companies raising tens of millions, if not hundreds of millions of dollars. And again, said, that just, I don't think that's going to pay off for those investors. I'm not sure how they're creating the TAM estimates that they are, but hey, it's not my money, so who am I to judge? So I think your instinct is probably right, because I I'm not always right, but I sort of had some initial suspicions that this was being overstated, and that there weren't going to be a lot of banks doing this. I mean, if you go back, the idea of partner banking has existed for far longer than most people realize. And so this, again, maybe a different name on it, but it's not that wholly unique that these kinds of partnerships have needed to exist.
Yeah, for sure. I mean, if you dial back the clock to before my time, but your bank corp and
Mhm.
formerly known as MetaBank and prepaid card programs.
That's right.
And actually even on the lending side, you had your like quote unquote rent to bank relationships for payday lending in the early 2000s that then
Hmm.
went away with regulatory pressure. So like the model itself is not inherently new. I think I tend to agree with your instinct about these standalone middleware players. Because if you ask yourself, what is the problem that they're solving? The way, at least the way it has been positioned previously is, oh, well, the community banks that are the largest players in partner banking, obviously due to Durbin Amendment, is they have this like, old, not great technology. As organizations, they may not necessarily be technologically sophisticated. And so the middleware, in theory, provides a sort of band-aid layer that makes it easier to integrate from a technology perspective. And then, you know, previously, and I think this is changing, previously maybe also supplied compliance support to the bank and to the fintech saying, okay, if you're a small community bank, you may not have the resources to deal with onboarding, due diligence, and oversight of these fintech programs. So maybe that's also a service we'll provide. But the question I ask is, if the technology piece is really essentially a band-aid, won't somebody come along and fix the underlying problem? And we've already seen that happening with, we need like cooler names for this, but I think of it as there's a term headless banking that people use in the UK, or maybe like API native, and that's Column, that's Lead Bank. So you have folks already starting to play in that space. Or, the core banking providers, this is also a capability that they should be able to provide. And you see
That's
FIS acquire Bond to sort of advance that agenda. And so it's like, okay, if it's either the bank is building it itself with its own technology, like the examples I gave, or the classic core providers offer this as like a module or a capability. Why does anyone need this standalone third party that's sitting in between taking cuts of every transaction?
Yep. Yeah, I think it's a totally fair assessment. So one thing, I got a whole bunch of questions, so I'm going to just kind of rapid fire. How do you think about, because I don't know that this is well understood either, is the way the banks are regulated, they have to think about the fintechs that they work with as third-party partners to the bank. But yet the fintechs generally look at the bank as a third-party provider to them, whether it's, rent a charter, as you said, or compliance services so that we stay in good stead with the regulated financial system, whatever it may be. How do you think about that confusion or tension?
That that is a really interesting and I think actually kind of unresolved question, right? So I mean, when I think about it, based on my understanding of like banking law and banking regulation, it would be that these fintechs are third-party service providers to the bank, and it's the bank's responsibility to oversee their service providers. But I do see the argument that, this almost flips it on its head, where banks, legally or not, kind of function as service providers to the fintechs, right? I mean, if you think of sort of like the order of operations of a customer of Chime or Dave or anything else, the customer interacts with the neobank, and then the neobank has one or perhaps multiple underlying bank partners that are powering that product. And so it is it is kind of, I guess, a lack of a better word, like a confusing paradigm, because now you have actually this sort of supplier risk running in both directions.
That's right.
Like the fintech is posing risks to the bank, both the regulatory stuff that we've talked about, but also balance sheet risk, right? If you look at Evolve's recent consent order, there's a requirement that it do a liquidity analysis before offboarding a program. That's because if you have a huge program take all its deposits and go somewhere else, that could pose a serious problem for the bank's balance sheet. And then in the reverse, if you're a fintech and your bank partner has an issue, maybe not as severe as sort of like the Evolve Synapse situation, your bank's issue as a supplier to the products you're building and offering also poses a serious and existential risk. So it runs both directions.
That's right. Yeah, and I've actually seen it firsthand. I had a scenario where we were working with a single bank and we were growing really fast as a fintech, and our amount of customer deposits relative to their total balance sheet was really big. And they said, slow down. And we said, we're in a fast growing fintech. Like there are those tensions that always appear. And I just don't know that that's been resolved in a way yet that everybody understands. But I think to your point, you're going to only continue to see increasing redundancy and risk management. One thing I wanted your thoughts on. There was a recent consent order that came out for a bank, and it mentioned fifth party risk and managing. And I thought, okay, well, we're just starting to talk about third party. I can maybe wrap my head around fourth party, but what in the world is fifth party? And is this the first time we're seeing this? And can anybody even define what that is? So just curious your thoughts on that.
Yeah, as far as I'm aware, the order you're referencing, I believe it's the first time the actual phrase banking as a service appeared in an
Hmm.
order. Obviously, it's been referenced using things like third-party risk management and partners and whatnot, but I don't think I've seen that specific phrase used before. And then, yes, also a lot of folks clocked the mention of fourth and fifth party risk. Um, yeah, I mean, if you start to think about how these layers get built on top of one another, okay, you could have a bank could work with a middleware firm could work with a vertical SaaS platform, and then that vertical SaaS platform could be offering like a business bank account that is, doing transactions. And you start to get this increasing number of hops, this increasing distance between, say, a seller on Shopify who uses Shopify Balance, which is powered by Stripe, which is powered by Evolve. And it's like, how well, what are the actual mechanics necessary for the bank to, know its customer through all of these hops? And so I do think that that is a very, real question that it seems that regulators are waking up to.
Yeah, totally agree. So just in that kind of rapid fire, do you think this is going to slow down?
I mean, the regulatory actions. I mean,
No, either
it's
that or
or
even just the
oh,
innovation, just the
okay,
just the innovation of the,
yeah,
of banking and fintech going everywhere.
yeah. I mean, so I think it's worth asking the question: why has this innovation been taking place outside of the banking regulatory perimeter? I think a part of that is sort of the attitude of regulators towards innovation itself, right? Which to be fair, has oscillated between administrations, right? I
Mhm.
mean, if you look back at Yelena McWilliams at FDIC or Brian Brooks at OCC, certainly had a much more accepting posture when it came to sort of new ideas or new approaches. I think we have definitely seen that pendulum swing the other
Mhm.
direction under current leadership. And not to say that that's not warranted, right? We've seen stuff blow up. Crypto blew up. A lot of people got hurt. Some stuff in fintech is currently blowing up with people getting hurt. So I'm not saying it's a completely irrational response, but we
Sure.
have seen that pendulum swing. And then I think there's also a question about, you know, bank culture. And I do want to be cognizant that, as I mentioned, it's not like I've spent, decades of my career working in community banks. I haven't. I will say it's my sort of general perception that, quote unquote, bankers or banking organizations tend to be a little more risk led, which I think is appropriate, right?
Mhm.
And I don't just mean regulatory compliance risk, but also balance sheet risk, credit risk, fraud risk. I mean, the full stack, right?
Sure.
Whereas, quote unquote, fintech or stuff outside of the banking perimeter, which is where I've spent more of my time, those organizations just culturally tend to be more software engineering and product management led. And I do think that sort of some of what we're seeing right now is the breakdown in how those two sides communicate, right?
Mhm.
And particularly because it's happening across organizations. So you might have bank in wherever, Virginia, Tennessee, Arkansas, wherever it is, and then you have fintech in San Francisco, New York, wherever it is, with sort of very different, you already pointed out sort of different objectives as far as growth,
Mhm.
right? Venture-backed fintech wants to grow very quickly, key to them going and raising more money, getting a high valuation, all that. Whereas the bank may have sort of different needs from that growth perspective, as well as sort of just different cultures and different ways of doing things.
Yeah, all amazing points. So we've seen all these consent orders. What do you think the regulators' biggest concerns actually are versus maybe even what they're indicating through their actions?
I'm always hesitant to try to guess what regulators are thinking.
I mean, we're outsiders. That's kind of
Yeah,
why
I
I'm
know.
interested in it, right? It's like it's speculation.
Yeah, I mean, I'm sympathetic in a sense that regulators have to balance a lot of competing goals and priorities, right? So, I mean, of course, there's sort of the systemic safety and soundness question, but then you also have questions around competition, which, again, particularly in the current administration, has been a very significant focal point, as well as questions about, access and inclusion. And so, yeah, I mean, taking, for example, something like, how KYC is handled. On the one hand, heightening KYC expectations should help mitigate things like money laundering risk.
Mhm.
And, money laundering is bad. It enables crime and terrorism and all sorts of other bad things. On the other hand, as you sort of crank up the pressure there, banks understandably respond by de-risking. Okay, makes sense. But that might have knock-on impacts where you're like, well, you don't, maybe you're undocumented and you only have a consular ID or a matricula. I'm not going to open you an account because I don't want to deal with a headache for what's going to be a low revenue customer anyway. So like, sorry, go somewhere
Sure.
else. Or, oh, okay, you run maybe a legal but higher risk business, like something in the adult field or
Mhm.
cannabis or I mean, to pick other side, like guns, ammunition, something that is a legal but higher risk business. I mean, it's like, do I really want to deal with a headache of building a compliance program to deal with that? No, I'm just not going to give these guys a bank account. And so, balancing these different factors, how do you ensure the safety and soundness of the banking system writ large, of individual institutions, deal with like, sort of the wider AML stuff, which is always an issue, promote competition if that is a policy goal, which currently it is, promote access and inclusion to core banking services and credit. Like it's literally impossible to achieve all of these at the same time. And so I think there's sort of a fluctuation of what is sort of the top priority at any
Mm.
given time. And given some of the stuff we've seen in BaaS and with partner banking, apparently, the current sort of regulatory priority is, how to put this, like encouraging banks that are going to pursue those business models to exercise greater caution in how they do that.
Hmm. I'll say a nice politically correct way to analyze it, I suppose. I'm not sure I understand. I think you articulate it well in that maybe it's not clear what their highest priority is based on their actions versus maybe what they're saying. And I think that's where I think there's high confusion in the marketplace. And I'm not sure anybody knows if they can do it right now. It's like we're going, if we want to find something that you're doing wrong, we can, given how we're posturing ourselves. And I just find that a difficult environment for people to operate in. Generally, people like to know, hey, if I want to play by the rules or by the spirit of the law, I'm going to be okay. And I think that's hopefully where we're going to navigate this industry, at least my view. Last question on this front. How do you think about this? I mean, we had, a year removed of some big bank failures or substantial bank failures. These partner banks generally are pretty small banks. How do you think about that and the systemic risks that they really pose to a system?
I mean, that's a great question. So, the pressure on community banks is very real, very understandable, and potentially existential. Like, I don't know how many times I've used like the exact same graph of like the number of banks in the number of chartered banks in the United States over time, and also the number of branches in the United States over time. Which interestingly, the number of branches actually like, kept going up until I think like 2008,
Mm,
2010, something like that. And so, if you think about historically, what have been small banks' biggest assets? One, their charters, obviously,
mhm,
and then two, the geographic footprint of the area that they serve. The charter is still valuable. The geographic footprint is a rapidly depreciating asset in an age of online banking and mobile
mhm,
banking.
mhm,
And so it's completely understandable if you're a community bank that is, potentially struggling to survive, you want to explore new avenues on how to do that. And again, given the expense and complexity of like building your own digital program, like partnerships are a very sort of like logical approach to doing that. I do think the the sort of blowback from the regulatory pendulum swinging the way it has is, whether it was the intent or not, the cost to do these partnerships have gone up and probably will continue to go up as far as the expense on the bank side to oversee, diligence and oversee those partners, as well as the expectation of where a fintech program is before a bank will even want to talk to it. And so, you know, again, whether or not that was sort of like the policy intent of these regulatory actions, I have no idea. It is very likely like that is and that will be the result. And so again, if you're, we've seen some community banks that have been in the space choose to exit, Blue Ridge,
mhm.
for example. We've seen some that have been hit with consent orders say, we're going to address these problems and move on, like Piermont. So I don't think it means everyone is going to stop doing it. I do, to use a Jason Henrich's term, I do think it means, folks who are, quote unquote, tourists and maybe thought, I'm just going to dabble in this as a business line because somebody at a conference mentioned it to me, or I've seen charts about ROE, ROA, and like, wow, they're doing 20, 30%, and my bank's at 10. It requires investment to do it in a way that is going to be sustainable and pass muster. And that takes time and resources and knowledge, and not everyone is going to be prepared to do that.
Yeah, total. So much gold there, Jason. I think that really sums up the reality. This is not a dip your toe in, dabble type of business for a bank to tinker with, right? And that is actually the advice I give to any of the banks that I talk to who are thinking about it, is to say, look, you have to take kind of the VC approach. If you're going to do this, it's going to be a portfolio, and you should expect not to just do this with one fintech partner. If you're going to do it, it needs to be a program, it needs to be a commitment, and you probably need a whole portfolio because they're not all going to work. But you also shouldn't be gambling your charter away. Make sure you have very clear compliance standards and expectations. So this is a evolving story for sure. I have this great feeling we're going to need to revisit this in another few months. So I would love to have you back. I'd love to talk more about digital marketing. My hope, I obviously work with a lot of banks. My hope is that a lot of more banks will learn from this and think about ways that they can provide more digital services to the market directly, and embed some of these capabilities as opposed to it needing to be these arm's length third parties. I think that's probably a more manageable, safer scenario. Any final thoughts there as we need to wrap at least this conversation, and we'll continue it from here.
Yeah, I mean, I think something that was appealing in, call it like the 2020 to 2022 timeframe is, the fintechs who were showing up wanting a bank partner had big VC checks, and they could use those big VC checks to go spend a bunch of money on marketing and get customers. And so, I suppose in an indirect sense, like those were subsidies to
That's
the
right.
bank that was getting those deposits and some fee revenue and whatnot. And the reality is, that seems to, in my opinion, sort of have distorted this market, whereas like, well, if a bunch of these fintech programs aren't actually sustainable on an economic basis, you know, they probably shouldn't exist,
Sure.
right? And likewise on the bank side, it's like, well, you know, if you're taking on fintech programs where the economics only work because, they have all this VC money, and so maybe as the bank, you're not needing to do certain things that in a more steady state you probably would need to do. I think it's been a much needed rationalization. I think you said something about letting sort of like the market forces, figure it out. It's like, well, you know, in a non-zero interest rate environment where like VC funding levels are more sane, like maybe all this stuff isn't actually sustainable. And I think that's what you know, I think that's the pain that we're feeling right now.
Yeah, so good, Jason. And I think spoken like a true digital marketer, where hey, for a bank to understand the unit economics of its fintech partner, probably an important thing for them to really understand and have somebody on their team who understands those unit economics and what a customer probably does cost in the marketplace, whether it's for you as a bank or your partner, because your point, the subsidies are not forever. So fun. I knew this would be a great conversation. Cut way too short. Hopefully more to come. Thanks for joining me today.
Thank you so much.
Thank you for listening to this week's episode of Operate Podcast. If you like this conversation, as a favor to me, you can rate us, review us, or subscribe, or tell your friends. You can also reach out to us on Twitter at Operate Podcast. Until next week, get out there and operate.